Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, I've got a fascinating one today.
We really do. Because, as an American investor right now, navigating a landscape dominated by the Trump administration, the new trade policies, the tariffs, all of that intense global competition, it is incredibly easy to just get totally distracted by the loud political headlines.
Oh, absolutely. The noise is just deafening right now.
Right. But to understand where the global economy is actually heading, we have to look past that political noise. So for today's deep dive, we are focusing on this one massive, almost silent shift happening right now as of mid-August 2026 inside China's economy.
And it's something that, honestly, almost nobody is interpreting correctly.
Exactly. According to recent analysis, China's central bank, the PBoC, is entirely changing how it manages the country's money. Imagine a central bank building the most sophisticated, state-of-the-art financial plumbing system the world has ever seen. They're offering incredibly cheap money, and here's the crazy part. Absolutely nobody wants to use it.
Yeah, it's a bizarre reality. We are talking about the mechanical foundation of how the world's second largest economy operates on a day-to-day basis.
Right.
I mean, for decades, the financial plumbing in China was, well, it was relatively crude. It was designed for a specific era of just explosive debt-fueled growth.
To really picture this for you listening at home, think about an economy as a massive garden. For the past 20 years, the Chinese central bank watered this garden using this blunt, high-pressure fire hose.
That's a great way to put it.
They would just open the valve, flood the state-owned banks with cash, and then those banks would hand billions over to massive property developers to build entire cities from scratch.
Brute force economics.
Exactly, just a brute force method. But in mid-August, they essentially locked away that old fire hose and installed this highly advanced smart sprinkler system.
And that historical context is so crucial here. Because during the 2000s and 2010s, China's growth model was entirely dependent on giant state-directed bank loans.
Right?
The central bank didn't need delicate tools. If the government wanted massive GDP growth, they just told the central bank to pump more reserves into the banking system, and the banks printed mortgages and corporate loans.
High volume, low precision.
Yeah, exactly. But that era of building endless infrastructure projects, it's hit a massive wall.
And we saw the pivot away from that brute force method very clearly on August 14th. Because according to the data, the central bank pumped 349 billion yuan into their financial system.
Which is a huge number.
Right, and then they immediately announced plans to inject up to 600 billion yuan daily between August 17th and 19th. Now, hundreds of billions of anything sounds like a return to the old fire hose, doesn't it?
It does on the surface, yeah.
But the actual mechanism they use is entirely different.
Right. So historically, when they wanted to add cash, their go-to tool was a 7-day reverse repo.
Okay, let's make sure that's crystal clear for the listener. A reverse repo is essentially a short-term pawn shop transaction for commercial banks, right?
Yeah, that's exactly what it is.
The central bank says, give me your ultra-safe government bonds to hold as collateral, and I will hand you cash.
Right, and in this specific pawn shop, the commercial bank gets to hold that cash for a full week before they have to return it, pay a little interest, and get their bonds back.
Okay.
It was a pretty clunky way of managing the water pressure. You dump a massive tank of water on the lawn once a week and just sort of hope it soaks in evenly.
But the structural shift we saw in mid-August was the heavy utilization of an overnight reverse repo.
Exactly.
So instead of locking in cash for a week, this overnight tool is like that daily smart sprinkler. It gives the banking system the exact, precise amount of cash it needs for just 24 hours. And then, boom, it takes that cash right back the very next day.
It's a fundamental transformation in how they manage the cost of money.
Yeah.
I mean, they are keeping their 7-day rate at 1.40% as the main anchor.
Right.
But they're using this new overnight rate, which is set slightly lower at 1.25%, to tightly manage daily cash shortages.
Yeah.
They're fixing the pipes to ensure that daily interest rates remain perfectly smooth.
Like hour by hour.
Day by day,
Yeah.
hour by hour, yeah. Rather than just pumping clunky amounts of permanent cash into the banks and walking away.
But, a central bank doesn't just redesign its entire operational framework for fun. Building this overnight smart sprinkler system requires a massive amount of daily intervention.
Oh, absolutely. It's labor intensive.
So what fundamentally changed in their financial garden to make the old 7-day fire hose obsolete? Like, why now?
Well, the answer lies in a really fascinating statistic from 2025. And this fundamentally redefines China's economy.
Okay, what is it?
For the first time in history, The share of direct financing in China, meaning money raised through corporate bonds, government bonds, and stocks combined, it hit 47%. Yeah, that actually surpassed traditional bank loans, which fell to 45% of total social financing.
That is a staggering reversal because, I mean, for my entire life as an American investor, the story of China has been the story of giant state-owned banks just acting as the sole engine of the economy.
Exactly. The government commands the banks to lend, the banks comply, and the economy grows. That was the formula.
But you're saying that monolithic banking era is officially over?
It's a complete structural transition. I mean, China is rapidly shifting from an economy purely driven by bank loans to one driven by modern capital markets.
So we're talking about a massive expansion of corporate bonds, municipal bonds, stock markets.
And non-bank financial institutions, too, like
Yeah.
private asset managers and mutual funds. Businesses are just bypassing the banks entirely and going directly to the market to raise money.
Ah, I see. Which means the central bank can't just play central bank for the commercial banks anymore. If the majority of the money is flowing through complex bond markets and asset managers, the PBoC has to become the central bank for the whole market. They have to protect a much wider, honestly, much more delicate ecosystem.
Right, because when you have a massive, complex bond market, absolute stability in the overnight lending rate is everything.
Gates of leverage, right?
Exactly.
Yeah.
In a developed bond market, financial institutions constantly borrow money overnight to buy longer-term bonds. They're using borrowed money to amplify their return.
And this is where the danger comes in for them. If I'm an asset manager and I've borrowed millions of yuan on a 24-hour basis to buy, say, 10-year bonds, I am assuming I can just roll over that overnight loan tomorrow at the same cheap rate.
You're betting your whole strategy on it.
Right. But if there's a sudden cash shortage in the banking system and the cost to borrow money overnight violently spikes, my entire strategy blows up. I suddenly can't afford to hold my positions.
And you'd be hit with immediate margin calls. To cover those skyrocketing overnight borrowing costs, you'd be forced to sell your long-term bonds just to raise cash.
And if every other asset manager is facing the exact same overnight cash squeeze,
Everyone rushes to the exit at the exact same time. That forced selling causes bond prices to crash across the board, which triggers even more margin calls.
wow.
Yeah, within hours, a minor cash shortage turns into a full-blown systemic market panic.
Okay, so this overnight smart sprinkler tool isn't a luxury, it's a desperate necessity. As their bond market grows to Western proportions, they need the ability to step in every single morning, calculate exactly how much cash is missing from the system, and inject it for 24 hours just to keep those overnight interest rates perfectly flat.
They absolutely have to prevent the margin calls from ever starting.
Which brings us to how the mainstream media is just completely misinterpreting this maneuver.
Oh, completely. It's wild to watch.
Right, because when I look at the research and see headlines flashing that the Chinese central bank is injecting 349 billion yuan on a random Wednesday and planning another 600 billion the next day, my American brain immediately thinks of massive economic stimulus.
Sure, of course it does.
I think of the 2020 COVID-era Federal Reserve, where they just flooded the zone with permanent cash to save a dying economy. Isn't this just the PBoC panicking and trying to force growth?
It is a very common assumption, especially for investors conditioned by the last 15 years of Western monetary policy. But it is entirely incorrect.
Okay, break that down for us.
What the PBoC is doing is not long-term quantitative easing. It is routine plumbing maintenance. Remember the mechanics of the tool? It's a 24-hour loan.
Right.
The cash goes in at 9 a.m., stabilizes the overnight borrowing rate, and is pulled right back out of the system the next morning. It never makes its way into the real economy to, build a factory or buy a car.
But why the sudden massive injections specifically in the middle of August? If it's just routine maintenance, why did the scale jump so drastically?
Well, that comes down to the mechanics of the calendar. Mid-month in China is the deadline for major corporations to pay their corporate taxes.
Oh, okay.
And simultaneously, it's a peak window for the national and local governments to issue large batches of new bonds to fund infrastructure.
Ugh, I see the collision there. When thousands of massive companies pay their taxes, billions in cash get sucked out of the commercial banking system and transferred into the government's central accounts.
Right.
And when institutional investors buy all those newly issued government bonds, even more cash leaves the private system. It creates a massive temporary vacuum.
Exactly. The water pressure in the financial pipes suddenly drops. And the central bank knows this mid-month vacuum is coming.
So they're simply turning on the overnight sprinkler for a few days to fill that temporary void?
Yes, they are holding the water pressure stable while the tax payments are processed and the bond auctions clear.
And the proof that this isn't a desperate stimulus flood is right there in the data. If you look at the 3 days leading up to this move from August 11th through the 13th, the central bank actually supplied 0 7-day funds to the market.
None at all.
For 3 consecutive days, they turned the water entirely off.
Think about it. If their overarching goal was to flood the economy with cash, to artificially stimulate GDP growth, they would never pause their regular injections for 3 days.
Right, that makes no sense.
They monitored the system, saw that the commercial banks had plenty of general liquidity, and held off. They specifically waited for that anticipated mid-month tax vacuum to deploy their new, highly precise overnight tool. They're micromanaging daily bumps. They are not trying to flood the house.
Okay, so the PBoC has successfully engineered a flawless irrigation system. The overnight borrowing rates are perfectly stable, the bond market is protected from margin calls, and the plumbing is state-of-the-art.
Yep.
But we have to confront the real elephant in the room here. The plumbing is fixed, the water pressure is perfect, but absolutely no one is turning on the tap. The soil is completely toxic, and nobody's planting seeds.
Yeah, this is where the narrative shifts away from mechanical financial engineering and just plunges straight into human psychology.
Let's talk about those numbers.
The credit figures coming out of China for July 2026 are alarming. New yuan loans, which measures the total amount of new money borrowed by the entire economy, dropped by a staggering 340 billion yuan.
Just to give you listeners some context on how devastating that number is, the consensus among market analysts was that new loans would increase by 45 billion yuan.
Right, the expected growth.
To miss the expectation by nearly 400 billion and to go deeply into negative territory, that is a seismic shock. It means old loans are being paid off or defaulting much faster than new loans are being taken out. The economy is literally shrinking its debt footprint.
And the breakdown of those numbers reveals where the pain is really concentrated. Household loans, which encompass residential mortgages and everyday consumer credit, fell by over 460 billion yuan.
Wow.
Corporate loans fell by 130 billion. We are witnessing a record-breaking contraction in the willingness to borrow. And all of this is unfolding alongside a second quarter GDP growth rate that just hit a 3.5-year low of 4.3%.
Let's bring this down to the street level, right? Because it perfectly highlights the limits of central banking. Imagine I am a commercial bank, and I offer you a 30-year mortgage at a ridiculously low 1% interest rate.
Sounds like a great deal.
The central bank has ensured my funding is cheap, so I pass those savings to you. The money is essentially free. But if you are terrified that your company is doing massive layoffs next month, or you look at your city and firmly believe residential real estate prices are going to crash by another 20% over the next 2 years.
You're never going to sign that paperwork.
Exactly. It doesn't matter if the interest rate is 1% or 0. Your fear of the future heavily outweighs the cheap cost of capital. It's a crisis of confidence.
I agree entirely. That is the exact psychological drought paralyzing China right now. The bottleneck is not a lack of available cash sitting in bank vaults. The banks have the money.
Right.
The bottleneck is a profound systemic lack of demand from consumers and businesses to actually take on risk. Perfecting the overnight interest rates is fantastic for institutional bond traders.
It ensures the financial sector doesn't implode.
Exactly. But a smooth overnight reverse repo rate does absolutely nothing to convince a young family in Beijing that it's safe to buy an apartment or convince a manufacturing executive in Shenzhen that there's enough consumer demand to justify building a new factory.
They are trying to solve a crisis of consumer confidence with a tool designed for banking liquidity.
Right. The central bank can guarantee that a corporate bond doesn't crash due to a temporary 24-hour cash squeeze. They possess the tools for that. But they do not possess a tool that forces that same corporation to hire 1,000 new workers if the corporation fundamentally believes everyday citizens are going to stop buying their products.
Monetary policy can provide the water, but it cannot make the horse drink.
Perfectly said.
So what does this actual reality mean for you, the American investor, trying to navigate global markets today? You're looking at an incredibly powerful central bank that has modernized its operations, but is presiding over an economy where the citizens have simply stopped borrowing.
Well, the most immediate reaction is playing out in the Chinese government bond market. Because households refuse to take out mortgages and corporations refuse to borrow for expansion, All of that excess cash trapped in the banking system has to go somewhere to earn a return.
It has to find a home.
Exactly. So it is flooding into the safest asset available, Chinese government bonds. This massive wave of buying has driven China's 10-year bond yield down to around 1.68%.
Now, on the surface, a country securing incredibly low borrowing costs seems like a victory, and the PBoC is definitely using this perceived stability to expand their geopolitical reach.
Yes, they are.
According to the data, they are introducing international mechanisms, specifically something called the FEMA RMB repo facility.
The FEMA RMB repo is a crucial development. It essentially allows foreign central banks to easily borrow Chinese yuan using Chinese government bonds as collateral.
Wait, let's pause on that for a second. Why does a foreign central bank need yuan in the first place? As an American investor, my radar immediately goes up. Are they trying to build a parallel system to bypass the US dollar for global trade?
That is exactly the long-term strategic goal. If a country in South America or Southeast Asia wants to trade directly with China without having to convert their local currency into US dollars first, they need a reliable, highly liquid way to access yuan.
Ah, I see.
By creating this repo facility, the PBoC is telling foreign central banks, hey, our financial plumbing is now perfectly stable, and you can access our currency on demand. It's a calculated long-term play to make the yuan a trusted international reserve currency that can eventually challenge dollar dominance.
That is massive. But locally, this rush into government bonds is creating a pretty terrifying balancing act for the central bank, isn't it?
Oh, it's a nightmare scenario.
Because a government complaining about incredibly cheap debt sounds crazy. But if I'm a domestic Chinese bank or insurance company and I'm buying government bonds that yield a measly 1.68%, my profit margins are basically zero.
Right.
To make any real money for my shareholders, I have to borrow a massive amount of cash to buy a mountainous pile of these low-yielding bonds. Is this a leverage trap?
That is exactly what's keeping PBoC officials awake at night. The banks and insurers are levering up to dangerous levels just to squeeze out a return. If the central bank allows those yields to drop too fast and every financial institution rushes to one side of the boat, it creates a colossal bubble of leverage.
Because if something unexpected happens, say inflation suddenly ticks up due to global commodity prices, or the central bank is forced to raise rates, the value of all those underlying bonds drops.
Yep. And all those institutions holding highly leveraged, paper-thin margin portfolios suddenly face devastating systemic losses.
Which would trigger the exact kind of catastrophic financial crisis the central bank spent all this time building the smart sprinkler system to prevent in the first place.
It's brutal. The PBoC is trapped in this high-stakes tightrope walk. They have to keep the overnight money flowing smoothly so the daily plumbing doesn't break. But they simultaneously have to step in and prevent bond interest rates from dropping so low that it creates an apocalyptic leverage bubble.
While knowing the soil is still toxic.
Exactly. And all the while, they know that absolutely none of this intricate financial maneuvering is solving the core cancer of the economy, which is the paralyzed consumer.
So to distill the ultimate lesson here, based on recent analysis as an investor, you have been trained for the last 15 years to view central bank action as an automatic trigger for an economic boom and a stock market rally.
The old money printer go brr logic.
Right. The prevailing logic was that you blindly buy stocks when central bank injects cash. What China is proving to the world right now is that this rule is dead. You have to separate the concept of liquidity from economic growth.
That is the key takeaway.
A central bank can engineer flawless monetary plumbing. They can micromanage overnight rates to the basis point, but perfect pipes cannot fix human psychology. You cannot assume stable plumbing means the underlying economy is recovering.
You really have to watch the actual credit demand. Are everyday people borrowing? Are real businesses expanding? Until those specific metrics turn around, that liquidity is just trapped inside the financial pipes, inflating dangerous bond bubbles without ever touching the real economy.
It's a sobering reality.
It really is, and it leaves us with one final, lingering question to ponder. If a powerful, globally dominant central bank can completely perfect the mechanical flow of money, but still cannot convince its own citizens to trust the future enough to spend or invest, what happens to global economic growth when an entire generation of a major economy simply decides they're done borrowing money?
Don't forget to subscribe and hit that like button.